Hey, what's up, guys? John here. The Fed is about to rug pull regional banks. That's not my opinion. They just said that about an hour ago. CNBC. They said they're getting ready for strict regulations on regional banks.
New regulations in the pipeline for large regional banks.
But if you look at who's funding all of these new standards that are going to be for the entire banking system in America, it's all the big banks. What we're witnessing is a massive rug pull on these regionals, these credit unions, and America. I mean, because America is built on small business, and most of the loans that fund small businesses are issued by these regional banks. And as they start to pull the rug on those banks, they're going to be pulling the rug on America. I'm going to break it down for you clearly with verifiable facts as to what is to come. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's really going on in America. And if you want to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you want to invest in real estate, you're waiting for a recession, you're waiting for some really distressed and motivated sellers, well, you're going to need great credit to get financing and funding. So we'd love to help you get there at GreatCreditFast.com. Take a look at this. Regional banks slide at their Fed's Kashkari advocates significantly further capital regulation, right? This came out literally an hour ago. So Minneapolis Federal Reserve President Neel Kashkari favors getting tougher on regional banks following a crisis earlier this year that he said may not be over. Asked during a town hall whether he agrees on the proposal setting higher capital regulations for banks with more than $100 billion in assets, the central bank official said, "My own personal opinion is it doesn't go far enough. I think it's a step in the right direction, but I'd likely go significantly further." They're going to continue increasing interest rates in the short term. A lot of people were anticipating that they were going to pivot in January. But yet here we are, we're in August, and they're saying that it's nowhere near over. And I agree with them. I think they're going to keep interest rates much higher for much, much longer. I think we're going to see home loans somewhere in the 9% range sometime next year. It sounds far-fetched, but we're already in the 8s right now. So the architect of the Troubled Asset Relief Program that helped bail out banks during the 2008 financial crisis, Kashkari, said that if the Fed has to keep raising interest rates, it could cause more problems for smaller banks. Well, that's of course the truth, because 67% of all commercial loans in America on commercial properties are all held by regional banks. A lot of money is getting pulled out of regional banks, especially over the last 6 months when you're looking at Silicon Valley Bank, First Republic, PacWest, that got acquired by Bank of California. I mean, you saw all these situations that Signature Bank, you saw all these situations that unfolded over the last 6 months, and it brought a lot of fear into the average American's mind, and they took that fear and they put it in the hands of big banks, right? JP Morgan, Bank of America, Wells Fargo. That's what the average American did. They took all their money out and they put it there. So you look at this. They're sitting on massive losses in their credit, commercial real estate, on auto loans, on credit cards, and they're dwindling deposits. It's a big problem, right? It's a big problem. But look at what's happening right now. Look at this partnership with big banks and the Fed and the government. I mean, this is JP Morgan owes $3 billion to the U.S. government after banking crisis drains emergency fund, right? So America's biggest banks are preparing to pay billions of dollars to Federal Deposit Insurance Corporation to replenish an insurance fund that's propping up the system. JP Morgan, Wells Fargo, Bank of America, Goldman Sachs, Morgan Stanley, PNC Financial Services Group, and Citigroup will collectively pay $8.2 billion to restore the emergency fund. Right? So they're all working together. And people think that, the Fed creates money. No, banks lend money into existence. And so if you have all the biggest banks all working together, bringing forward some type of emergency fund, what's ultimately going to happen? As these regionals start to fall, these big banks are going to get stronger and stronger and stronger. And when you have an option, when the everyday American has an option of thousands of different small credit loan unions, local banks, large banks, and then that changes to possibly 5, 10, 15, 20 banks in the next 4 or 5 years, what are you going to have? You're going to have a lot more regulation in these big banks. They're going to be able to control Americans to an extent which I think a lot of people just aren't prepared for yet. JP Morgan will pay a total of $3 billion, by far the largest of all the banks. The fees are part of the FDIC's special assessment implementation that is proposed in May to create a new system where the cost of protecting depositors is covered by the payments from the large financial institutions. I mean, it's right here. Read that again. I mean, the fees are part of the FDIC's special assessment implementation that is proposed in May to create a new system where the cost of protecting depositors is covered by payments from large financial institutions. Under the new system, the banking organizations with over $50 billion in total assets have to pay 95% of the special assessment, while those under $5 billion won't be subject to the assessment at all. The FDIC says 113 firms collectively subject to the new rules. Right? The proposal applies the special assessments to the types of banking organizations that benefited mostly from the protection of uninsured deposits. In general, large banks with large amounts of uninsured deposits benefited the most from the systematic risk of determination. The FDIC's move comes from the U.S. financial institutions tighter than their control over the American banking system. While many of the smaller competitions closed down, the latest small bank failures was July, right? And they list a few. Heartland Tri-State Bank of Elkhart, Kansas shut down and had 2 assets transferred to Dream First Bank National Association, also based in Kansas. JP Morgan, which is the biggest bank in the U.S., recorded an impressive Q2 presentation, which recorded 67% rise in quarterly profits to $14.47 billion in the quarter ending June 30th, despite larger drop in deposits, right? So you're starting to see the trend here, but watch it. FDIC Chairman Gruenberg calls for tougher regulations on large regional banks, right? So they're not going to hit that threshold. These larger regional banks, they're going to support these big banks. And this, it's an unfortunate situation because these small regional banks, they create so much value for the everyday American. And witnessing all these massive changes, looking where the everyday American really stands, it's so much easier for someone to go out there and get a loan, an auto loan from like an AV Federal or one of these small banks. But when you have this, essentially takeover of the entire banking system, you're going to have such tight capital controls. It's going to get so much harder to get funding and financing, especially as you start seeing more and more of these smaller banks consolidate, and they'll have more of a reason why not to lend money. But I think they're going to lend it just to borrowers that have great credit, that are really responsible, that offer very little risk. Large institutions, of course. A lot of the A players are going to get access to funding. I've been talking about this for a while. I mean, right now, Americans have accumulated staggering $1.03 trillion in total credit card debt. Goldman Sachs predicts there's not going to be a pivot until the second quarter of next year. I've even seen guesstimates around like June, sometime that of next year. I mean, you're talking 10 months, a year, essentially. Like, that is a very long time, especially when you look at what a lot of Americans have done. They purchased properties last year and a half, thinking that they're going to see a Fed pivot and they're going to get to refinance their rates at a much lower interest rate. That doesn't seem to be happening. If you look where mortgage rates are right now, if you have a 700 to a 719 credit score, you're looking at an 8.1% mortgage. So just for context, they say the average credit score now in America, they say is 714, although it was always 698, at least in the last 12 months. Now they're saying the average is around 714. I don't think it's 714. I think it's probably closer to 700. But regardless, $500,000 purchase price, $30,000 down, 6%, 30-year fixed rate, 8% mortgage, $4,318. I mean, who can afford that, right? Who can afford that? I mean, that doesn't include maintenance, doesn't include repairs, doesn't include being, the cost of being a property owner. You're probably looking around $4,800 to $5,000 a month is what you would really need to be able to buy the average home. And why would you buy that property when you could rent the average home in America for $2,100, $2,000, right? And not be responsible for any of the repairs, not be responsible for any of the maintenance, not be responsible for anything, right? The average American renter right now, they're saying pays $1,326 a month. I mean, they are putting the golden handcuffs on the housing market. They're putting the handcuffs around lending. I mean, this is all going to change. But if you look at what smart money is doing, Starwood, for example, own 180,000 homes. They are pitching a new distressed real estate fund. They already have $10 billion that's raised. And their Blackstone $30 billion fund, and they're going mainly their conviction is rental housing. So if you look at what Blackstone's doing, you look at what Starwood is doing. You look at what, even FDIC enlists BlackRock to clean up banking cast-offs, right? You start to just follow the trends. We're witnessing the everyday American consumer in very big trouble. And it's going to just get harder and harder. That's why, when I say it's the greatest wealth transfer of all time, it really is. I think it's going to get very interesting in the very near future. American consumers carry $5,947 in the average credit card debt. But a lot of people have more credit card debt than that. They say the average interest rate right now is 24.37%. That is just shocking. So if you just look at this number, 24%, right? Let's just say hypothetically you have $20,000 in credit card debt. If you just say, instead of it being 24.37%, it's just 24%. Look at the difference, right? The difference on just that 0.37%, it goes from $56,000 in interest, and then if you just add that 0.37, you would think it's barely going to go up. No, it goes from $56,887 to $75,000, just at 0.37%. So every time the Fed increases interest rates slightly, you're going to see more and more and more increases of interest owed on credit cards, on these auto loans, on all these adjustable rate loans. But just for the everyday American, $5,947, I believe, was the number that they said is the average. Yeah, $5,947. If you just put that 24% and you say, you know, you're not going to pay, a lot of people aren't going to pay $400. They're going to pay $250, right? If they're paying $250 a month, I mean, they're still paying, you know, $2,200 in interest if they're paying $250. That's on $5,947, right? That's on $5,947. A lot of people are going to probably pay closer to $150, but at $150, they are, you know, they're around $6,000 in interest. But I think that a lot of people have credit card debt around $10,000, and that $10,000 credit card debt, just for easy math, 24%, you need to pay $200 a month. So, and that was at 24%, not 24.37%. So let's see, 210, right? So 210, you're looking at $22,000 in interest on 10,000, right? So if you add the 0.37%, that, you know, $10,000 balance, $22,000 in interest would go to an extra $3,000 basically of interest, an extra $3,000 of interest, $25,000 total over 14 years, right? So this is what I'm seeing going to happen. I bet we're going to start to see more and more and more regulation on these banks. These larger banks are already in partnership to work together. So these large banks are already in partnership to work together. They're already calling for significant capital regulation on these regional banks. So they're going to get tougher on these regional banks at a time in which they're already weak, right? They're being positioned to fail. So if you are a business owner, if you are an investor, if you are an entrepreneur, the time to get everything in order, all your affairs in order, is right now. The next 6 to 12 months is going to be so important. If you want to invest in real estate, if you want to get out of credit card debt, if you have any of these plans, the time to implement them is right now. I'm not saying run out there and invest in real estate right now, but I'm saying you want to get all of your, you know, everything done in advance so that when you see that great opportunity, you can go pounce on it. If you have credit card debt right now, the most foolish thing anyone can do is sit there and pay $25,000 in interest on a $10,000 balance at 24%. Because if you were to do a balance transfer and you transfer to 0% interest and you paid the same payment, it would go from 14 years to 4 years, right? Now, of course, you'd try to pay more, but you know, you'd be able to hack out a lot of that debt at 0% interest. Ideally, you could pay, say, $450 or $400, and you know, in the course of, there's a lot of credit cards out there that offer 21, 24-month 0% interest, 0% APR, and if you could pay, you know, $400 a month, you're basically out of credit card debt, 0%, no interest at all in 2 years versus, you know, 15. But what do you think? What do you think about this entire situation with regional banks, with what's happening with the banking system? I think we're going to see Jerome Powell increase interest rates again this next month. We're going to see him continue to increase in the short term, 25 basis points most likely in the next few meetings. And things are about to get really, really interesting in America. What do you think about it? Drop below, hit the like button, add me on IG. And if you want to fix your credit, we'd love to help you at my company, GreatCreditFast.com. We're helping a lot of people position themselves right now for this great wealth transfer. If you have bad credit, your credit's not where it should be, get a hold of us. Book a call. GreatCreditFast.com. You can find more information in the link below this video. And catch you guys in the next one.